Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah, and over the next 25 minutes, we'll discuss about 2 or 3 aspects of a mutual fund, either behavior or offerings or otherwise. Now, what we are going to be doing today, let me give you a quick synopsis. We are going to be starting off by talking about how, while mutual funds invest typically for the long term, when it comes to the primary markets, the data seems to suggest otherwise. And it's quite fascinating, really, this data digging that has been done by Ventura Securities. So that is part 1. Part 2, as much as all of us have tried to understand what our portfolio construct should be, how cool would it be if an expert could come and tell us that if we are designing a portfolio right now, depending on the kind of investor that we are, what are the different components in the portfolio that should be, and why so? And therefore, that is something that we'll talk with our guests as well, a portfolio construct, if you will, depending on the risk appetite that you have. And thirdly, what a lot of people get sucked into, and I use the term sucked into very, very carefully and judiciously, what a lot of people get sucked into, which is go for a debt scheme which gives dividend. Because the dividend is effectively your own money, and the dividend need not necessarily be dependable, and it may not be the wisest thing to do as well. So to talk about all of these aspects, for the first time on the Mutual Fund Show, Juzer Gabajiwala is Director of Ventura Securities, joins us right now. Juzer, great having you. Thanks so much for joining, and I hope all is safe.
Thank you, Neeraj. Thank you for having me on your show.
Now, the pleasure is ours. So, Juzer, let's start off with the first data point that was really eye-opening, so to say, that while we talk about mutual fund investing being for the long term, in the primary markets, it seems to be anything but long term.
Yeah, so I mean, we just saw that there, in the last 1 year, we have seen a spate of IPOs coming and hitting the markets, and we have obviously seen the retail interest spike and even the HNI component and markets. You have seen the way they have been. So we just said that, how are the mutual funds doing on the, primary market? So we just tried to, do some analysis. So we just realized that nearly in the last 1 year, we had some 35, 36 IPOs which came in. And we saw that nearly most of the mutual funds have also participated, I think, through nearly 1,000 odd schemes where they invested. And the only thing is that 45% of those IPOs, they've already exited. So, in terms of, and because they have a minimum holding period of 1 month, right? So I think, so they, the same way as what I think the retail is trying to do at their end, trying to play the IPO market, I think the mutual funds are also, trying to benefit the investors by trying to at least, some of them are even in cashing and holding, and, because they have a separate allotment which they get. So that was just an internal study which we did. So,
yeah, I don't think viewers that Juzer is trying to draw any inferences out of it, but the data is just interesting. And Juzer, the key was when I looked at the data that you've given, right? Different scheme, different fund houses, Sundaram, SBI, Aditya Birla, etc. It's very interesting that in so many of these cases, the number of exits either equal to or at times is greater than 50% of the number of companies applied for, which means that there's a clear pattern. Mutual funds are consciously getting the allocation and then exiting it in a month's time. So they're effectively doing the trading game as well, so to say.
Yeah, or you can look at the other way around, like, it looks attractive to buy at a particular price, and the way the premiums are getting commanded, I mean, so you might as well encash your profit. I mean, I think that's what it seems to be like. I mean, you would always have to evaluate in the stock market, right? That, so at a particular price, something is good to buy. And if you expect that the stock price in 1 year should, let us say, even if you say should appreciate by 20%, 30%, and if you get an appreciation in 1 month, then why would you want to wait for 1 year? So,
well, that's the other way of looking at it, and maybe that is some. But the stats are interesting. One, as to what are the different kind of fund houses that are doing that. And there's also a select set of companies in which there has been a high concentration of fund houses that exited as well, right? I mean, if I'm not wrong, Equitas, Mrs. Bector's, and Chemcon, in that order. Some very, very interesting figures. Can you talk a bit about this?
Yeah, so I mean, what we just then try to analyze, a little bit of a deep dive, that which are the ones which were, the top five in terms of percentage exits. So we just saw that Equitas was one of them where it was the top exit. Then Mrs. Bector's. So this is purely on the FMCG space. So that also has been exited. Chemcon. Then we had Indigo Paints. Okay, not Indigo Airlines, Indigo Paints, and Burger King. So means these gave a good listing premium. So I guess maybe it looked good to encash out. So.
Well, viewers, we haven't given you all the data that Juzer Gabajiwala had shared with us, but for example, the top 5 companies that are still held by AMCs, this is not a stock conversation show, but I'm still telling you some of those names. So top 5 companies still held by AMCs include Sona, Gland Pharma, MTAR, CAMS, or Chemcon. And the max percentage of IPO applied by fund houses, actually houses like Nippon, Birla, etc., are the ones which are right up there. Juzer, is there a pattern into any of these? Part 1, and 2. The more important question that comes to mind is that would any of these gain? Would you believe that if the IPO markets stay as hot as they are right now, presumably through the year, then actually you might see more of this behavior if the markets stay all right? Because 1, as you said, people might want to take gains. 2, because there are certain gains on the table. So the mutual fund manager is saying, why should I be dumb and say I'm only long only? I can make gains. Let me make gains for my investors.
Yeah, so I mean, see, mutual funds are the benefit of having is that they always will be having amounts available with them. They get a part of an anchor allotment, so they are able to do a good chunky allotment, and I think that they have played it very smartly. And I think so, investors have benefited out of it, because I mean, if you see in this 36 issues, nearly 72% of the issues have been at a premium, okay, and 28% has been at a discount. But I think the premium which has got commanded has far outweighed the ones which were at a discount. And what I've seen also is that some of the ones which opened at a discount were also quite judiciously avoided by the mutual funds. So there is it's not just like how a retail would be applying that they would just look at what are the premium going on, you apply. I mean, because the stakes are lower. And here the stakes are much higher. Like, I mean, we have seen the amount of mutual fund interest even in the Zomato issue. And I mean, at 76, and everybody is talking about it, that it has got an absurd valuation. But the fact of the matter is that it listed at 125, 130 is a rate. And so that's a very good premium you're making in just 1 month's time. These type of returns you wait for a year in a particular stock.
Well, it also applies to some names in which there was very, very little interest, like Macrotech, and the company from that time has actually nearly doubled. So it's pretty interesting, that behavior.
Right.
Sure. Okay. So Juzer, that point is well taken. And viewers, this was just very interesting data analysis that we wanted to do, and which is why we thought is best to talk about it. Now, the 2 other topics at hand. One of them, which I see more and more people getting sucked into, and at times it's also a conversation done by the client by virtue of having heard it somewhere or otherwise, that let me invest in a fund, but I want that regular income and that dividend that you want to give me. Or at times the client gets sucked into by wrong advice. Now, Juzer, can you talk a bit about this dividend that is declared and the way people go in for that, believing that that's the holy grail? Can you talk a bit about that? Because I'm sure you've seen this behavior all through the last 15, 20, 25 years that you've been in this field.
Yeah, so I mean, see, what happened is that I think if we go back to maybe around 2018, and so till that time, dividends were tax free. Okay, so that was the biggest advantage which was there. So we used to have something what is called as dividend distribution tax. Okay, so the tax was being paid by the fund house. As far as the investor was concerned, he was getting dividend which was tax free in his hands. Okay, so everything was quite hunky dory. Then we were also witnessing at one side that the fixed deposit rates, were dropping. So interest rates were coming down, and people obviously are used to getting a particular amount of money. So we used to have a lot of these balance funds at that point of time. So these balance, there's a hybrid with equity type of a taxation, and so a lot of people started investing over there because the dividend was tax free. The dividend was, the tax was still being paid by the mutual fund. Okay, that also not many people were realizing. But since you are getting it tax free, you are oblivious of the fact that somebody else is paying the tax. But the whole scenario underwent a change when on effective 1st April 2020, the finance minister in the budget announced that now dividend is taxable. So that was a real change. Not only previously the equity shares, they were also taxed provided the income exceeded a particular amount, and even the mutual fund was tax free. After the announcement, now you face two problems. One is that not only are you paying tax on the dividend income, but the second thing what would happen is that even your tax slab could undergo a change. So to give you an example, if there is some investor all along he has been getting good hefty dividend amount, okay, and his taxable income was very low. Let us say he was in the maybe 10% or 20% tax bracket. So he was say earning 7-8 lakhs, and he could be earning around 7-8 lakhs by way of dividend. So his tax slab also now changes. So from a 20%, he will come into the 30% tax slab. Okay. So first of all, now he will start paying tax on the dividend. Secondly, what he would be paying as 20%. So now he moves into the 30% tax slab. And one needs to understand that in mutual fund, the dividend which is declared is more out of selling of shares. Right? It is not like a company dividend where the company's dividend is more determined by the amount of his sale of the products. Right? So whether you get a capital appreciation or whether you get a dividend, right? So at the end of the day, both are the same. So for a dividend option to be in a mutual fund, according to me, it was it's not a very good decision, and we have been trying to educate our customers across the board that it is extremely tax inefficient for you to stay invested in a dividend option today.
Well, I hope people are listening into this, and viewers, frankly, if you have more questions around this, please write to us on our Twitter handles, or my Twitter handle, or the BloombergQuint Twitter handle, and we'll try and get Mr. Gabajiwala to even address some more queries if you had them. But largely put, as he explained in the last line very succinctly, it is very tax inefficient to be in the dividend option. So please keep that at the back of your mind. If somebody is trying to sell you a dividend option saying that, oh, you get this fixed dividend this year, it may stay the same the next year, then just please be wary of this. At least do some checks before you go out and put money there on the mutual fund side, that is. Okay, now Juzer, a bunch of people have been writing to us on social media again about what is it that they should do with individual portfolios. Now we've done, at least in the last 3 months, around a couple of shows around portfolio construct and with specific schemes. But here we thought we'll ask you that if you were to look at 3 classes of investors, one is a new investor, one is an existing investor, and one is a seasoned investor into mutual funds, what is it that you reckon their portfolio composition should be in order to derive the biggest bang for the buck with the equity markets being where they are and the interest rates being where they are?
So
And why, of course. Please tell us a why as well.
So Neeraj, I'm a very firm believer that that for everyone there is a different way of investing. Okay, and specifically right now, I mean, most of the people who have stayed away from the market mainly because of the view that right now with the COVID scenario, it's going to crash and the whole thing is going to, come down. So there is as it is, there's a lot of, we are in a very, very negative environment today. And at the other side, they are also witnessing that the markets are going up, right? So suddenly they are seeing that, everybody is talking about that I made 20%, 30%, 40% returns. Small cap funds have given this type of returns. So there is a huge, FOMO factor, right? So you have a fear of missing out. So the thing which my advice to a new investor is that don't try to look at trading. I mean, in fact, before I got into the call with you, I just spoke to one of the person and new to the markets and says that I want to start trading. Okay. So I think we have to be very, very careful, specifically in a market like this. And if you are a first-time investor, it is the best way to get into is to do a SIP. I mean, I am an absolute fan of SIP. I mean, I've been doing it for the last 15 years since the time I have started, doing the mutual fund business, and I've realized the benefit of that. And it is one product where you cannot go wrong. And so for a new investor, the best, simplest way is, start an SIP. Whatever amount you are comfortable, do that. Do it in a large cap fund because that's the safest way. Or now you have one more category where, you can do it in a flexi cap fund where you could have large, mid and small caps. So you don't have to bother about it. And I think that's the simplest decision. Start off over there. Slowly you start to get experience and you can start moving over there. So, that is my advice to a new investor. Then you have what you want is for the existing investor. So you have some of the existing investors who would have tried a lot of things. Some people would have tried to, exit out, try to, maybe, time the market. I mean, I think that's extremely, for a better word, foolhardy because, nobody has ever got it right in terms of trying to time the market. And trying to time the market, you will always be 50% right or 50% wrong. There's no two ways to it. So why take that chance? And if you have found that your schemes are not making good returns or anything, follow a simple principle. Have a again example for them, and specifically in today's market, it's best to do an SIP rather than trying to put a money lump sum because even I don't know where the markets are headed. Everybody is talking of an imminent correction, and we crossed 17,000 in a matter of less than a month, from 16,000 to 17,000 in less than a month. So when the correction has happened, nobody knows. When the markets are going to top out, nobody knows. Investment is a journey. You need to, ride that journey. It will be a roller coaster ride. Do not expect that it will be just one way upward movement. With every rise, you'll also get a fall. So here you can, existing investor can bifurcate his money between a large cap fund. He can do 50%, 30% in a mid cap, 20% in a small cap, because we have already seen a reasonably good run up in the small cap and the mid cap in the last year. So, I think this is a good bet. So that is my advice for existing investors. And thirdly is where you have a person who's a seasoned investor, where he's doing everything, he's seen it all. I'm sure he must be doing his SIPs and all that. So one thing what they can start looking at is that we have always looked ourselves within. Now we have to start looking at outside, right? So we need to start looking at international funds. It's a great opportunity, great instrument that you can start with even 5,000 and 10,000 and buy the Googles and Apples of the world today, which is not available over here. So we are using all these products, right? So now you have an opportunity to also invest in these products. And I think we have seen a lot of growth and opportunities in India. And now with the whole technology revolution which is happening across the globe, and all global funds are now coming into the Indian, investing circle. So I think this is another opportunity which you should not miss out. You should have around, at least 10 to 15% allocation should be given to international funds. It could be any geography. I mean, you can pick and choose because now you have got a lot of these options which are made available.
Sure. Okay. Juzer, out of the blue though, off topic from what we discussed, but before we wrap up the show, I just wanted one quick perspective from you. There's news that came out today. I don't know if you have an opinion or no, but let me ask you nevertheless, that Navi Mutual Fund, which is I think the Sachin Bansal's unit, has filed to SEBI for a FOF feeding into the Vanguard Total Stock Market Index. And I think the math seemed to suggest that if Vanguard's expense ratio is only 0.04%, the SEBI rules will cap the combined FOF at just 0.12%. Now, which would mean extremely dramatically low expense ratios for any investor. Is this something that could change the expense structures available in the existing mutual fund landscape within India? I don't know if you have an answer or no, but I just thought I'll ask.
I also briefly just read about it, so I don't know what it is, the whole construct is about. But you also need to understand one thing, that so Vanguard has been there for a very, very long time in terms of as a fund house, and we are talking about ETFs being very popular in US and everything, right? But it started gaining popularity way later on. I mean, you should understand that, so I think if I'm not mistaken, Vanguard has been there for last maybe around more than 40 years. And their ETF investing has started getting prominence only in the last 10-15 years. Right? The US market is an extremely mature market. I mean, the size of the US market, we are nowhere near it. Right? Our Nifty 50 is market cap is equal to one Apple. In fact, even Apple has got a more market cap than the Nifty 50. So we are talking about potential of what it is going to happen out here, how it is going to pan out. We can always have you can have different data points for argument in favor of ETF, in favor of actively managed funds. So ultimately, it has to see. Ultimately, the investor has to choose what is best for him, right? So and it is your experience will be different from my experience.
Sure. Okay.
We could be buying the same fund, but at two different points of time.
Sure.
So it all depends upon each one's individual experience and choices.
Fair call. Okay, Juzer, this was lovely. Thank you so much for taking the time out and speaking to us today, and all the best, and stay safe, more importantly.
Thank you, Neeraj. Thank you for having me.
Pleasure. As viewers, thanks for tuning into this leg of the Mutual Fund Show.